Imagine this. Two people look at the same stock. One sees an exciting opportunity to get rich overnight. The other sees a dangerous trap that could wipe out savings. Who is right? Here is the twist. Both are looking at the same numbers, but only one of them knows how to read them. That difference between chasing illusions and uncovering truth is the difference between speculation and investment. And this is exactly where Security Analysis by Benjamin Graham and David Dodd steps in. This book is not about hot tips or guessing tomorrow's price. It is about learning a discipline, a framework, a lens that allows you to see the financial world with clarity. It is the playbook that Warren Buffett once called his Bible. But here is the catch. It does not promise instant wealth. It promises something more powerful: the ability to separate noise from value, to recognize when the market is lying, and to act with confidence when everyone else is confused. Why do some investors consistently survive crashes while others lose everything? Why do some portfolios grow steadily for decades while others burn out in one risky bet? The answer lies in one central idea that this book will unfold slowly. An idea so simple, yet so often ignored, that it can protect you against disaster while opening doors to wealth. What is it? And to discover it, you must journey through the pages ahead. Step by step, part by part, until the final revelation makes it crystal clear. The margin of safety. And the journey begins here. With Part 1, Survey and Approach, where Graham and Dodd set the stage by showing us the scope and limits of security analysis. They remind us of an uncomfortable truth. We cannot predict the future, but we can prepare for it. Part 1, Survey and Approach. Every great journey begins with a map. But what if the map itself has limits? What if the very tools we use to navigate investments can only take us so far? This is the puzzle Benjamin Graham and David Dodd place before us at the start. Security analysis is powerful, but it is not perfect. It can reveal hidden truths, but it cannot promise certainty. Here lies the first challenge for every investor: to accept that knowledge has boundaries. And yet, within those boundaries lies immense power. The question is, how much can analysis really achieve? And where must caution begin? That is exactly what Chapter 1 explores: the scope and the limitations of security analysis. Chapter 1, Introduction, Scope and Limitations of Security Analysis. Every science has its limits. Even the most advanced tools cannot guarantee perfection. Security analysis is no different. It offers investors a way to think clearly about financial decisions, but it cannot eliminate uncertainty. Benjamin Graham and David Dodd open their classic by warning us: do not expect analysis to predict the future with certainty. Instead, expect it to create a logical foundation for making decisions. The role of the analyst is not fortune-telling. It is interpretation. It is careful judgment built on facts, not on wishes. The first step is to understand what security analysis is meant to do. It studies financial statements, balance sheets, income accounts, and company reports. It searches for the real strength and weaknesses of a business. Its goal is to find the truth behind the numbers. But here comes the limitation. Even the best analysis cannot foresee wars, political revolutions, sudden economic crises, or natural disasters. These unknowns are beyond the reach of numbers. So the analyst must remain humble. He must remember that markets can surprise anyone. Still, analysis has great value. It allows the investor to avoid blind speculation. It helps in separating companies with solid foundations from those built on illusions. It gives the investor a rational anchor in a sea of market emotions. Graham and Dodd emphasize discipline. The analyst cannot be swayed by hope, fear, or market noise. Instead, he must ask, is the company truly able to protect the investor's money? Does it have a record of stable earnings? Are its assets real and strong? If the answer is yes, then the security deserves attention. At the same time, analysis must remain flexible. The world changes. Industries rise and fall. Methods that worked in the past may not always work in the future, so the intelligent analyst adapts, but he never abandons the principles of logic, evidence, and caution. The authors also point out another important truth. Most mistakes in investing come not from lack of intelligence, but from overconfidence. People believe they can outsmart the market. They trust predictions that sound certain, but are built on weak foundations. Here, security analysis acts as a defense. It keeps the investor grounded in facts rather than fantasies. So what should we take from this first chapter? That security analysis is both powerful and limited. It cannot promise wealth, but it can prevent disaster. It cannot predict the future, but it can prepare us for it. And above all, it gives us the discipline to remain rational when others lose control. And now comes the natural question. If analysis is both powerful and limited, how exactly do we define its scope? What areas of finance can it truly master? And where must we admit its boundaries? These questions lead us directly into Chapter 2. The scope and limitations of security analysis continued. Chapter 2. The scope and limitations of security analysis continued. The second chapter deepens the discussion of what security analysis can and cannot do. Graham and Dodd remind us that the analyst is not a prophet. He is more like a doctor. A doctor cannot guarantee life, but he can diagnose, prevent, and improve chances of survival. In the same way, an analyst cannot guarantee profits, but he can diagnose weaknesses, avoid risks, and improve chances of success. The scope of security analysis lies in facts. Numbers do not lie, but they can be misread. The analyst's job is to test those numbers, compare them with reality, and build a logical conclusion. For example, if a company's earnings cover its interest many times over, that is a strong sign of safety. If assets are greater than debts, that provides protection. These are within the scope of analysis, but there are strict limitations. Analysis cannot account for political revolutions, sudden natural disasters, or unexpected human behavior. It cannot forecast the timing of booms or crashes. No formula can predict exactly when optimism will turn to panic. Therefore, the wise analyst does not try to predict everything. He accepts uncertainty and builds a margin of safety. The authors stress another key point. Security analysis works best when applied to groups of securities rather than single bets. Looking at one company may lead to mistakes, but examining a wide group gives a more reliable picture. Patterns and averages are more dependable than isolated cases. This is why Graham often relied on statistical studies of many companies, not just one. Another limitation is human emotion. Even when analysis shows danger, people often ignore it. During market bubbles, investors dismiss logic. They believe this time is different. In truth, no amount of analysis can protect someone who refuses to listen to reason. Yet despite all these boundaries, analysis remains essential. It is the compass that keeps investors from drifting aimlessly. It cannot guarantee the destination, but it can keep the ship away from rocks. So what is the lesson of this chapter? That security analysis has clear power, but only within defined territory. It is like a flashlight. It cannot light the whole forest, but it can guide you safely along the path in front of you. With this foundation, Graham and Dodd prepare us for the next step. If analysis is about finding the truth of a business, then we need a central guiding star. Something that helps us measure whether a security is really worth buying. That guiding star is the concept of intrinsic value, and it is in Chapter 3 that the authors introduce this core idea. The very heart of security analysis. Chapter 3. The concept of intrinsic value. At the core of security analysis stands one powerful idea: intrinsic value. It is the true worth of a security based on facts, not market emotions. Graham and Dodd explain that market prices are often misleading. Sometimes they are too high, driven by excitement and greed. Other times they are too low, pulled down by fear and panic. But underneath these waves, every business has a real value. That is what the analyst must uncover. So what is intrinsic value? It is not a single number fixed forever. It is an estimate based on careful study of earnings, dividends, assets, and long-term prospects. Think of it as the weight of gold inside a box. The market may argue about the box's decoration, but the analyst wants to know how much gold is inside. For example, if a company regularly earns strong profits, owns valuable assets, and pays steady dividends, its intrinsic value is high. If another company has unstable earnings, heavy debts, and doubtful assets, its intrinsic value is low. The market may confuse these two, but the analyst must see clearly. Why does intrinsic value matter? Because it allows investors to make rational choices. If the market price is far below intrinsic value, the investor has an opportunity. If the market price is far above intrinsic value, the investor faces danger. The gap between price and value creates risk or reward. Graham and Dodd stress that intrinsic value is not about perfection. It is about reasonable judgment. Different analysts may estimate slightly different numbers, but the point is not to be exact to the penny. The point is to have a reliable anchor that guides decisions. This is why intrinsic value is so powerful. It pulls the investor away from market illusions. It forces him to ask, what is this business really worth? Not what people hope it will be worth tomorrow, but what the facts suggest today. However, knowing intrinsic value is not enough. The investor must also understand his own role. Will he act as an investor, guided by logic and safety, or as a speculator, chasing market moods without foundation? This question leads directly to the next chapter, where Graham and Dodd draw a sharp line between investment and speculation. A line that every investor must recognize before risking a single dollar. Chapter 4. Distinctions between investment and speculation. Every investor must face a simple but dangerous question. Am I investing or am I speculating? Benjamin Graham and David Dodd draw a clear line between the two. An investment, they say, has 3 conditions. It is based on thorough analysis. It guarantees safety of principal. And it offers a satisfactory return. If any of these conditions are missing, then the act is speculation. It does not matter what name you give it. It does not matter how confident you feel. Without analysis, without safety, without reasonable return, it is speculation. This definition is not meant to condemn speculation entirely. Speculation will always exist. It can even be exciting and at times profitable. But the real danger is confusion. When speculation disguises itself as investment, investors fall into traps. Consider an example. A man buys shares of a fashionable new company simply because its price is rising. He convinces himself that it is an investment, but he has no analysis of earnings, no idea of risks, no margin of safety. In truth, he is speculating. On the other hand, another man buys bonds of a stable railroad company after careful study. He knows the income record, the assets, the protective covenants. This is investment. It may not bring spectacular gains overnight, but it carries discipline, safety, and reliability. The authors also warn against a subtle trap. Sometimes, what begins as investment quietly turns into speculation. A stock bought for its steady dividends may tempt the owner to hold it during wild price swings, hoping for a quick profit. The line becomes blurred. That is why discipline and honesty are essential. The true investor must constantly ask, am I being guided by facts and principles? Or am I being carried away by hope, fear, or greed? By keeping this distinction clear, investors can protect themselves from ruin. So what lesson does this chapter leave us with? That speculation is not evil, but it is dangerous when misunderstood. Investment is built on analysis and safety. Speculation is built on guesswork and emotion. The wise investor must keep the two separate. And now, with the difference made clear, Graham and Dodd move to the practical world of securities themselves. They turn their attention to the most fundamental type of investment, one where safety of principal is tested most directly: bonds and other fixed-value securities. This marks the beginning of Part 2, the selection of fixed-value investments. Part 2, Fixed-Value Investments. If common stocks are the arena of uncertainty, then fixed-value investments are the fortress of stability. Here, the focus is not on dazzling profits, but on protection of capital. Bonds, debentures, and preferred stocks form this world. Their value lies in their promise of steady payments and their priority claim on assets. Benjamin Graham and David Dodd remind us that the first duty of an investor is not to make money, but to keep money safe. A fixed value investment may not deliver excitement, but it delivers discipline. It builds a foundation on which other, riskier ventures can stand. This part of the book explores how to judge these securities. The authors show that numbers matter. Coverage ratios, earnings history, and balance sheet strength decide whether a bond is truly safe. They also show that legal covenants and contractual promises protect bondholders when companies are tempted to take risks. But this part is not only about numbers. It is about philosophy. The investor must accept that a modest, steady return with safety is better than chasing spectacular gains with danger. A sound bond, paying its interest year after year, may not make headlines, but it can protect an investor through depressions and crashes. At the same time, Graham and Dodd warn that not all bonds and fixed securities are safe. History is filled with cases where investors assumed safety, only to lose everything when earnings collapsed or debts piled too high. Therefore, selection becomes the art and science of the fixed income investor. Which bond deserves trust? Which preferred stock carries real protection? And which seemingly safe issue hides danger under the surface? This is the battlefield of Part 2. It is here that the authors arm us with rules, tests, and principles. Rules that can guide an investor through the maze of securities, keeping him safe from disaster. And the first step is the most important one. How to choose fixed value investments in the first place. What qualities should the investor demand before committing capital? This brings us directly to Chapter 5, the selection of fixed value investments. Chapter 5, the selection of fixed value investments. Now we step into the world of fixed value investments. These are securities like bonds and preferred stocks that promise a fixed return. Unlike common stocks, their income is usually predetermined. This makes them appear safer at first glance, but appearances can be misleading. Benjamin Graham and David Dodd explain that the key question in selecting fixed value investments is not how much they yield. It is whether the principal is safe. The investor's first duty is to protect the original capital. If the return is high, but the principal is at risk, then the investment is not truly sound. The authors stress that many investors are seduced by higher interest rates. They forget that a higher return usually signals higher risk. For example, a shaky company might offer a bond paying 7%. A strong company may offer only 4%. Attractive as the higher rate may look, the weaker company might fail, leaving the investor with heavy losses. So how should an investor choose? The rule is clear. Safety of principal must always come before return. If the capital is lost, even the highest promised interest becomes worthless. The analysis of fixed value investments therefore requires careful study of several factors. First, the stability of the issuing company's earnings. Second, the sufficiency of its assets to cover debts. Third, the presence of protective covenants that limit management from reckless actions. Another important point is the difference between short-term and long-term obligations. Short-term obligations may be paid easily when business is stable. But if earnings fall, the company must still meet its long-term bond interest year after year. The analyst must ensure that the company can handle this burden in both good times and bad. Graham and Dodd also highlight the importance of industry conditions. Even a strong company in a declining industry may face danger. For example, railroads once dominated American finance, but as cars and planes grew, many railroads struggled to pay bondholders. This shows why analysis must extend beyond numbers into the realities of business life. Finally, they remind us that fixed value investments are not meant to make investors rich quickly. Their true role is preservation of wealth and steady income. Chasing unusually high returns in this field almost always leads to speculation. The lesson of this chapter is simple but profound. Select fixed value investments by focusing first on safety of principal. Then look at the adequacy of return. Never reverse the order. And with this foundation, the authors take us one step further. If safety of principal is the golden rule, how exactly do we test it? What standards must be applied to judge whether a bond or preferred stock is truly safe? This critical question is answered in the next discussion. Chapter 6. The Rule of Safety of Principle. Chapter 6. The Rule of Safety of Principle. Safety of principle is the heart of fixed value investing. Benjamin Graham and David Dodd repeat this rule again and again because it protects investors from disaster. The idea is simple but powerful. Before you think about how much you might earn, you must first be sure that your money will not be lost. This principle may sound obvious, yet history shows that many investors forget it. They chase higher interest rates or attractive dividends without asking if the company can truly meet its promises. When trouble comes, those promises collapse, leaving investors with heavy losses. So how do we apply this rule in practice? The analyst must carefully examine whether a company's earnings and assets provide a cushion. Even in bad years, will the company still be able to pay interest on bonds or dividends on preferred stock? If the answer is uncertain, then the investment is not safe. Graham and Dodd emphasize the concept of coverage. This means the ratio of earnings to fixed charges like interest. If a company earns only slightly more than it owes, then a small downturn could wipe out its ability to pay. But if its earnings are many times greater than its fixed charges, then the investor can feel secure. Assets also matter. If a company owns valuable property, machinery, or cash reserves, these can support bondholders during difficult times. But inflated asset values, or excessive reliance on intangibles, should be viewed with suspicion. The analyst must separate real strength from accounting illusions. Another key aspect is management behavior. A company might have resources, but reckless leaders can destroy safety. Borrowing too heavily, paying out excessive dividends, or engaging in risky expansions all threaten the protection of principle. The authors also caution against blind faith in diversification. Owning many unsafe bonds does not create safety. It only spreads the danger. True protection comes from the quality of each individual investment, not the quantity. Ultimately, the rule of safety of principle is more than a formula. It is a mindset. It requires the investor to think defensively, always prepared for the unexpected. It shifts the focus from maximizing gains to minimizing losses. And in the long run, this defensive posture proves to be the best defense. The chapter closes with a guiding thought. The investor who insists on safety of principle may sometimes accept lower returns, but he also avoids the disasters that wipe out careless investors. In the end, he preserves not only his money, but also his peace of mind. And so the natural question follows. If safety is based on coverage and assets, how do we measure these factors in detail? What numbers should the analyst study, and how should they be interpreted? This leads us directly into the next step of the journey. Chapter 7. Quantitative Factors in Bond Analysis. Chapter 7. Quantitative Factors in Bond Analysis. When we speak about bonds, one thing matters above all. Can the company pay its interest year after year without fail? This is where quantitative analysis becomes critical. Numbers tell the story of a company's strength or weakness. The most important measure is interest coverage. This means how many times a company's earnings before interest and taxes can cover its interest payments. For example, if a company earns 10 million and its annual interest is 2 million, the coverage ratio is 5 times. This shows a strong cushion. But if the ratio is only 1.5 times, the risk increases. A small drop in earnings may cause default. Another key measure is stability of earnings. Bondholders do not care about spectacular growth. They care about consistency. A company with moderate but steady earnings is safer than a company with high profits one year and losses the next. The size of the company also plays a role. Large companies often have more resources, stronger credit, and access to capital markets. Smaller firms may be vulnerable to competition or economic swings. The capital structure must also be studied. If a company already has a heavy load of debt, adding more bonds increases danger. Analysts check the ratio of funded debt to equity. Too much leverage means a small decline in earnings could ruin the company. Asset protection is another factor. Bondholders want assurance that tangible assets like plants, property, or inventory are enough to secure the debt. If earnings fail, assets act as the final safeguard. The analyst must also study profit margins. Thin margins leave little room for mistakes. Wide margins provide flexibility. Finally, industry conditions cannot be ignored. Even a strong company may suffer if the entire industry is in decline. Railroads in the early 20th century are an example. Many had solid histories, but declining revenues made their bonds unsafe. Quantitative analysis, therefore, is not just about checking one ratio. It is about building a complete picture. Earnings coverage, stability, size, assets, debt levels, margins, and industry trends. Together, they show whether a bond deserves confidence or suspicion. But numbers alone are not enough. A bond may look safe on paper and still be ruined by poor management choices. This is why Graham and Dodd stress not only quantitative factors, but also protective covenants written into the bond contract. These legal protections are the focus of the next chapter. Chapter 8. The Protective Covenant. Numbers may reveal the strength of a company, but numbers alone cannot protect investors. That protection often comes from the bond contract itself. This is where protective covenants become essential. A covenant is simply a promise. It is a rule placed inside the bond agreement that restricts the company from taking actions that could harm bondholders. Think of it as a safety lock. Even if management wants to act recklessly, the covenant forces discipline. One common covenant limits the company from issuing too much new debt. Without such a rule, management could borrow endlessly, piling obligations on top of existing ones. This would weaken the safety of earlier bondholders. By restricting new debt, the covenant preserves stability. Another covenant may require the company to maintain certain financial ratios. For example, the ratio of assets to debt must not fall below a set point. If the ratio drops, bondholders gain the right to demand repayment or corrective action. This ensures that the company keeps its balance sheet in healthy condition. Covenants can also control the use of profits. Some contracts require that a portion of earnings go into a sinking fund. This fund is used to gradually pay off the debt before maturity. It reduces the chance of sudden default in the future. There are also covenants protecting against asset sales. A company cannot sell off factories, land, or subsidiaries without ensuring that bondholders remain secure. This prevents management from stripping the company of value and leaving creditors exposed. Other covenants may restrict dividend payments to shareholders. If too much cash is paid out as dividends, less remains to service the debt. By limiting dividends, the covenant ensures bondholders are paid first. These protective rules show us that bond analysis is not just financial science, it is also legal science. The words written in the bond contract can make the difference between safety and disaster. For the cautious investor, studying covenants is just as important as studying financial ratios. Graham and Dodd emphasize that covenants are often ignored by casual investors, but professionals know they are the backbone of bond safety. A weak covenant can turn a seemingly strong bond into a dangerous one. A strong covenant can rescue an otherwise moderate issue. In short, protective covenants are the silent guardians of fixed income investors. They restrict reckless actions, ensure discipline, and guarantee that bondholders are respected. But what about securities that stand between bonds and stocks? Those that promise a fixed return, yet lack the same level of legal safety. This brings us to the next subject: preferred stocks. Their theory, their risks, and the special care they demand will be explored in Chapter 9. Chapter 9. The Theory of Preferred Stocks. Preferred stock is a special type of security. It stands halfway between bonds and common stock. Like bonds, it pays a fixed return, usually called a dividend. Like common stock, it represents ownership in the company. But unlike bonds, preferred stock has no fixed maturity date. And unlike common stock, it usually has no voting rights. At first glance, preferred stock may look safe. It offers a steady income stream. It seems less risky than common stock because dividends are fixed. But Graham and Dodd warn us. Preferred stock is not as safe as many people think. The key problem lies in its position in the company's financial structure. Bondholders have the first claim on earnings and assets. Common stockholders have the last claim. Preferred stockholders sit in the middle. This makes them vulnerable. If the company struggles, bondholders are paid first. Preferred dividends may be skipped without causing bankruptcy. Common shareholders may still hope for growth in the future. But preferred shareholders are left with nothing. So preferred stock carries a hidden risk. It offers limited reward, but still faces danger in hard times. It lacks the strong protection of bonds, and it lacks the growth potential of common stock. Does this mean preferred stock has no place in investing? Not exactly. In certain cases, preferred stock can be justified. If the issuing company has stable and strong earnings, the dividends may be reliable. If protective covenants are strong, preferred holders may gain extra security. Sometimes, preferred shares are created for special financing purposes, like balancing debt and equity. But Graham and Dodd are cautious. They argue that preferred stock is fundamentally weaker than bonds, and it does not provide the flexibility of common stock. It is often issued by companies that cannot safely sell more bonds. This fact alone should make investors alert. Why is the company turning to preferred stock instead of safer financing? Usually, it signals weakness. Therefore, the theory of preferred stock is a warning. Investors must never treat it as a safe, fixed income instrument. It belongs in the category of securities that demand extra careful analysis, which brings us naturally to the next step. If preferred stock is risky in theory, how do we analyze it in practice? What numbers, tests, and methods can reveal whether a preferred issue is truly safe or dangerously weak? These questions lead us directly into Chapter 10. The Analysis of Preferred Stocks. Chapter 10. The Analysis of Preferred Stocks. Now that we understand the theory behind preferred stocks, the next challenge is to analyze them in detail. Graham and Dodd stress that preferred stockholders face a special risk. They depend entirely on the stability of earnings. If a company cannot pay interest on bonds, it defaults. But if it cannot pay dividends on preferred stock, it simply suspends payment. There is no legal protection. The investor is left waiting. So how should preferred stocks be analyzed? The first and most important step is to study earnings coverage. Are the company's earnings large and stable enough to cover preferred dividends many times over? A narrow coverage means danger. Even a single bad year can wipe out payments. The second step is to examine the balance sheet. Strong assets support preferred obligations. If assets are weak or heavily mortgaged, preferred holders have little security. Third, the analyst must look at the history of dividend payments. Has the company maintained preferred dividends through difficult times? Or has it shown a habit of suspending them? Past behavior is often the best guide to future treatment. Fourth, the investor should judge the company's overall financial policy. Does management act conservatively? Or does it take unnecessary risks? A reckless policy can quickly endanger preferred dividends. Graham and Dodd conclude that preferred stocks are often more speculative than they appear. They look steady, but in truth, they can collapse during downturns. This is why the authors are critical of investors who blindly treat them as safe investments. Preferred stocks demand the same careful analysis as bonds, and often even stricter tests. The lesson is clear. Preferred stocks may have a place, but only in rare cases where earnings are strong, covenants are protective, and management is trustworthy. For most investors, bonds offer greater safety, while common stocks offer greater opportunity. Preferred stocks sit uncomfortably in between. And here lies the connection to what comes next. If even preferred stocks carry speculative features, then what about other senior securities that openly combine stability with speculation? What about income bonds, adjustment issues, convertibles, and warrants? These securities blur the line between investment and speculation. Understanding them requires a deeper dive into their technical features and risks. That is exactly what begins in the next section. Part 3. Senior securities with speculative features. Part 3. Senior securities with speculative features. So far, we have looked at securities that promise stability, bonds that protect the principal, preferred stocks that aim to give steady dividends. These instruments are designed for safety. But what happens when even senior securities carry an element of speculation? This is where investing becomes more complex. On paper, senior securities should be the safest. They stand higher in the chain of claims. they receive priority before common stockholders. But reality tells a different story. Many of these securities still hide risks that can surprise the careless investor. Why is this so? Because companies often design securities not just for safety, but also to attract buyers. They add features like convertibility, income-dependent payments, or warrants. These features make the securities more appealing in the market, but they also add uncertainty. Suddenly, what looks like a bond may behave like a speculative stock. Graham and Dodd remind us, the analyst must not be blinded by the title senior security. He must dig deeper. He must ask, what guarantees truly exist, and what elements of speculation are silently present? This part of the book explores that tension between the promise of priority and the reality of risk, between contractual obligations and market temptations, and between safety and speculation. The journey begins with the foundation. Before we can evaluate risks, we must first understand the technical design of these instruments. How do senior securities work in practice? What rights do they give? And what limits do they carry? That is the subject of Chapter 11. The technical characteristics of senior securities. Chapter 11. Technical characteristics of senior securities. Senior securities stand at the top of the financial ladder. They are called senior because they have priority over other forms of capital. This means they get paid before common stockholders. And in times of crisis, their claims are honored first. But what does this priority really mean? And how does it work in practice? The two most common senior securities are bonds and preferred stocks. Bonds are contracts. They obligate the company to pay fixed interest at fixed times. Failure to do so means legal default. This makes bonds appear very safe. Preferred stocks, on the other hand, are not contracts in the same sense. They promise dividends, but companies can suspend these payments if earnings are too weak. Preferred stockholders cannot always force payment through legal action. So even though they rank above common stockholders, they are less secure than bondholders. Another characteristic is claim on assets. If a company fails and is liquidated, bondholders have the first right to company assets. Preferred stockholders come after them. Common stockholders come last. This order of priority defines how safe or risky each class of security is. Then there are protective covenants. These are rules written into bond agreements. They restrict management from taking reckless steps, such as issuing too much new debt or selling assets without permission. Such covenants give bondholders extra security. Preferred stocks, however, often lack strong covenants. This makes them more exposed to management decisions. We also need to consider voting rights. Bonds rarely give bondholders a say in company affairs. Preferred stockholders sometimes gain voting power, especially if dividends remain unpaid. Common stockholders, however, always control the company. This shows that with greater safety often comes less control. Finally, senior securities differ in flexibility of return. Bondholders are locked into fixed payments. They cannot benefit if earnings rise. Preferred stockholders may gain some advantages, but still have limited upside. It is the common stockholders who enjoy the most reward when business thrives. This technical structure reveals a paradox. Senior securities are safer because they have priority and fixed claims. But they are also limited. Their rewards are capped, while their risks, especially for preferreds, can still be significant. So the analyst must understand these characteristics deeply. Without this knowledge, it is easy to be misled by the title senior security, because priority alone does not remove every danger. And this leads directly to the next question. If these securities are supposed to be safe, what factors can make them speculative? What hidden risks turn a senior claim into a gamble? That is the subject of Chapter 12. Speculative factors in senior securities. Chapter 12. Speculative factors in senior securities. In the previous chapter, we looked at the technical characteristics of senior securities. But technical structure alone is not enough to decide safety. Every investment also carries speculative elements, even when it is backed by strong contracts. This chapter focuses on those speculative factors. Senior securities are usually bonds and preferred stocks. They are designed to be safer than common stock. Yet, they are never free from risk. The moment a company faces pressure in its earnings, even senior securities can lose value. Speculation enters through many doors. The first factor is the earnings of the company. If earnings are stable and cover fixed charges many times, the security is safer. But if earnings fluctuate with the economy, the security becomes speculative. A bondholder depends entirely on the ability of the business to pay interest. If profits collapse, bonds can default. The second factor is the industry position. Some industries are naturally stable, like public utilities. Others are highly cyclical, like steel or automobiles. So, a bond issued by a steel company is more speculative than one issued by a water supply company. The third factor is management policy. Even a strong company can be made speculative if management takes reckless risks. If management issues too many bonds, debt levels rise. If they expand aggressively in uncertain markets, earnings become unstable. Thus, investors must judge not only numbers, but also the attitude of leadership. The fourth factor is external conditions. War, regulation, inflation, or depression can shake even the strongest securities. History shows that senior securities are never fully insulated from economic shocks. During the Great Depression, many once safe bonds defaulted. The lesson is clear. Senior securities may look safe, but they can turn speculative depending on circumstances. Investors must weigh both technical features and speculative realities. A wise analyst does not just ask, "What does this bond promise?" He also asks, "How vulnerable is it to forces beyond control?" And this naturally leads us to the next subject. If speculative factors play such a big role, we need to study them in specific industries. The best way to see this is by examining how bonds behave in real cases. And the first case we will explore is the railroad industry. This brings us to Chapter 13, the analysis of railroad bonds. Chapter 13, the analysis of railroad bonds. Railroads were once the backbone of industrial America. In the late 19th and early 20th centuries, they were the lifeline of commerce, moving goods, raw materials, and people across vast distances. Because of their central role, railroad companies became some of the largest issuers of bonds. For decades, railroad bonds were seen as the safest form of corporate investment, almost like government securities. But history teaches us that safety is never permanent. Railroad bankruptcies were not uncommon. Even great systems, with thousands of miles of track, faced financial distress when mismanagement, competition, or economic depression struck. Therefore, analyzing railroad bonds requires more than blind faith in the industry's importance. The first step in evaluating railroad bonds is to examine the stability of earnings. Railroads had heavy fixed charges: wages, maintenance, fuel, interest on debt. If revenues dropped due to recessions, strikes, or overexpansion, companies could not easily cut costs. This made them vulnerable to default. A second factor is the traffic base. Railroads serving diverse regions with mixed freight, coal, agricultural produce, manufactured goods, were more stable than those dependent on one commodity. For example, a line dependent only on coal shipments could collapse if demand for coal fell. Geography also plays a decisive role. Railroads controlling key routes, such as those connecting major industrial cities or ports, had an advantage. Those in remote or sparsely populated areas faced chronic weakness. In finance, location can mean survival. Another consideration is competition. During periods of overbuilding, multiple railroads fought for the same territory. This destroyed profitability, driving some systems into bankruptcy. The presence of parallel lines must always be weighed carefully. Then comes the structure of debt. Railroads often issued bonds secured by mortgages on sections of track, rolling stock, or terminals. But the layers of senior and junior obligations could be highly complex. Analysts must study whether bondholders truly have enforceable claims in case of default. A bond with strong legal protection is far more secure than one buried under multiple prior liens. Finally, one must judge management quality. Railroads required constant maintenance and large reinvestment. A poorly run company could squander even strong revenues through inefficiency or corruption. History records many railroads ruined by reckless expansion or dishonest practices. In short, the analysis of railroad bonds combines earnings stability, traffic diversity, geographic importance, competitive position, debt structure, and managerial integrity. Only by balancing all these elements can an investor judge whether such bonds are truly safe or merely appear so. And just as the railroad bond investor must consider the special characteristics of this industry, the same logic applies to another great field of American finance, the public utility companies. In the next chapter, we turn to the analysis of public utility bonds, where the challenges are different but no less critical. Chapter 14. The analysis of public utility bonds. Public utility companies provide essential services. Electricity, gas, water, and transportation form the backbone of daily life. Because their services are needed no matter the economy, their bonds often seem safer than those of industrial companies. Investors are naturally attracted to utilities for this perceived stability, but the surface safety of public utility bonds hides complexities. Earnings are generally more predictable than railroads, yet they are often constrained by government regulation. Rates charged to consumers must be approved by public authorities. This limits profits, but it also protects investors from extreme losses. The first step in analysis is to examine revenue stability. Utilities with monopolistic or near-monopolistic positions have steady cash flows. Competition is usually limited, making income more predictable. However, rising operational costs or unexpected maintenance can strain finances even in strong companies. Second, the capital structure of the utility matters. Many utilities have significant debt to finance infrastructure. Senior bonds secured by property or equipment provide relative safety, but excessive leverage can make a company vulnerable to interest rate changes or declining revenues. Third, regulatory environment is critical. Governments can impose rate ceilings or enforce service obligations. While this protects the public, it may reduce profitability. An investor must understand how rules affect both earnings and the ability to pay interest. Another consideration is asset quality. Infrastructure such as power plants, pipelines, and transmission lines must be maintained. Deferred maintenance or poor investment planning can erode the bond's safety over time. The balance between depreciation and upkeep is a subtle but essential factor. Management quality is also vital. Experienced leadership ensures that capital projects are completed on time and within budget. Poor decisions can turn a seemingly secure bond into a speculative risk. Lastly, the analyst must consider economic and technological change. New energy sources, environmental regulations, or shifts in consumer demand can alter the utility's revenue prospects. Even a well-managed company with a monopoly is not immune to change. In essence, public utility bonds combine the promise of stability with unique regulatory and operational risks. The intelligent investor must weigh these factors carefully. Unlike railroads, where competition and traffic dictated risk, in utilities the rules, management, and regulatory environment dominate. Once we understand public utility bonds, the next step is to look at industrial bonds. Industries outside utilities and railroads behave differently, with distinct risks and opportunities. This leads naturally to Chapter 15, Industrial Bond Analysis, where we examine how to evaluate bonds in the broader corporate world. Chapter 15, Industrial Bond Analysis. Industrial bonds are issued by companies engaged in manufacturing, mining, and other commercial activities. Unlike railroads or utilities, these companies face far more volatile markets. Their earnings depend heavily on economic cycles, consumer demand, and global conditions. This makes industrial bonds inherently more speculative than many senior securities. The first factor in analyzing industrial bonds is earnings stability. A company with predictable profits over multiple years is safer. But industries like steel, textiles, or automobiles experience booms and busts. An investor must assess how the company has weathered past economic downturns. Second, the capital structure matters. Industrial companies often carry multiple layers of debt. Senior bonds are prioritized in claims, but junior bonds and preferred stocks increase financial complexity. High leverage can amplify both risk and reward. The analyst must determine whether the company can meet interest payments under stressed conditions. Third, asset quality plays a crucial role. Factories, machinery, and inventories must be real, properly valued, and maintained. Overstated or obsolete assets can mislead investors about the true security of the bond. Fourth, market position and competition are vital. A leading company with strong brand recognition and market share is better able to maintain earnings during economic slowdowns. Companies in highly competitive or declining markets are riskier. Management is another key factor. Industrial firms require experienced leadership capable of controlling costs, expanding efficiently, and responding to market changes. Mismanagement can turn a technically strong bond into a speculative gamble. External conditions also influence risk. Economic recessions, raw material price fluctuations, and international trade issues can affect earnings. Even the best analyzed bond can be impacted by factors beyond control. Analysts must also consider protective covenants in bond agreements. These may restrict new debt, limit dividend payments, or enforce minimum liquidity. Strong covenants increase safety. Weak ones leave the bond more exposed. In essence, industrial bonds offer opportunity, but demand careful evaluation. Unlike railroads or utilities, risk depends less on regulation or monopoly, and more on the company's ability to survive economic cycles. Understanding industrial bonds prepares us for a more complex category. Some securities do not pay fixed interest, or their payment depends on company income. This introduces a new challenge. The next chapter explores these complexities in Chapter 16, The Theory of Income Bonds and Adjustment Issues. Chapter 16, The Theory of Income Bonds and Adjustment Issues. Income bonds are a unique type of security. Unlike traditional bonds, they do not promise fixed interest payments. Instead, payment depends on the earnings of the issuing company. If the company earns enough, bondholders receive interest. If earnings are insufficient, payment may be skipped without legal default. At first glance, income bonds may appear risky. There is no guaranteed income. Yet they are designed to help companies during financial distress. By linking payments to profits, companies avoid bankruptcy while providing bondholders a chance to earn if recovery occurs. Analyzing income bonds requires a careful look at company earnings. The analyst must estimate future profits under realistic conditions. Past performance provides clues, but it is never a guarantee. Even small fluctuations in income can dramatically affect the safety of the bond. Next, adjustment issues arise when a company restructures its debt. Debt may be converted into income bonds, or senior bonds may be subordinated. Analysts must study these adjustments to understand who truly has priority and how risk shifts among creditors. This often requires reading legal documents and corporate agreements carefully. Another factor is the company's ability to recover. Income bonds work best in firms with sound assets, but temporary earnings problems. If the company is fundamentally weak, income bonds may become worthless. Investors must also consider market perception. Income bonds may trade at a discount, reflecting both risk and potential reward. Speculative investors may be attracted, but prudent analysts focus on underlying fundamentals. Finally, income bonds highlight a broader truth. Not all senior securities behave the same way. Some are fixed and predictable. Others are income-dependent and speculative. Understanding the difference is essential for sound investment. Once we understand income bonds and their adjustments, we are ready to explore convertible securities and warrants. These instruments combine features of bonds and stocks, offering opportunities but also adding complexity. This naturally leads to Chapter 17, The Analysis of Convertible Issues and Warrants. Chapter 17, The Analysis of Convertible Issues and Warrants. Convertible securities are unique instruments that combine characteristics of both bonds and stocks. A convertible bond pays fixed interest like a regular bond, but can be exchanged for a predetermined number of common shares. Warrants, on the other hand, give the holder the right to purchase stock at a fixed price for a specific period. The appeal of these instruments is obvious. They offer the safety of a bond with the potential upside of stock ownership. Investors gain income through interest while also keeping the option to benefit from company growth. But this combination of features also introduces complexity and risk. The first factor to consider is conversion terms. The conversion ratio determines how many shares the bond can become. A favorable ratio increases the potential for profit, while an unfavorable ratio may reduce the value of the security. Second is market conditions. If the company's stock performs poorly, conversion is less attractive. The investor may choose to hold the bond for interest, but this limits gains. If the stock rises dramatically, conversion becomes highly valuable. Understanding market potential is critical. Next is credit risk. Even a convertible bond is still a debt instrument. The company must pay interest and principal if conversion does not occur. Default risk exists, especially in weaker companies. Warrants add another layer of complexity. They are highly sensitive to stock price movements. Small fluctuations in the underlying stock can greatly impact their market value. Warrants may expire worthless if stock prices do not reach the exercise price. Analysts also examine interest rate sensitivity. Rising interest rates can reduce the market value of bonds, including convertibles. This affects potential returns and the attractiveness of conversion. Finally, management policy and company fundamentals matter. A company with strong earnings and growth prospects makes conversion more appealing. Poorly managed firms increase the speculative nature of these securities. In essence, convertibles and warrants illustrate the blending of safety and speculation. They offer the potential for higher rewards, but require careful analysis. Investors must evaluate the bond-like safety, the stock-like upside, and all underlying risks. With this understanding of convertibles and warrants, we conclude Part 3. The next section, Part 4, Theory of Common Stock Investment, shifts focus entirely to stocks. Here, the stakes are higher, risks are greater, and potential rewards are far more dramatic. Part 4. Theory of Common Stock Investment. Now the focus shifts. Until this point, the book has guided us through bonds, preferred stocks, and senior securities. These were investments where the return was mostly fixed and predictable. But common stocks are different. They represent ownership, they carry greater risks, and they also carry the greatest potential rewards. Common stock investment is both the most attractive and the most dangerous field in finance. It is attractive because it offers the possibility of unlimited growth. It is dangerous because it tempts investors to forget discipline and chase illusions. The authors explain that the theory of common stock investment must be built on the same foundation as all other analysis: facts, logic, and caution. But at the same time, new questions must be faced. How do we value earnings? How much weight should dividends carry? What role do company assets play? And above all, how should we judge intrinsic value compared to the market price? Graham and Dodd warn that many investors fall into traps with common stocks. They are carried away by excitement. They believe in endless prosperity. They accept theories that sound good but collapse in practice. This happened most clearly during the boom of the 1920s. And this brings us to the first topic in this part: the so-called New Era Theory. A belief that stocks could only rise and that traditional rules no longer applied. Understanding this theory and its dangers is the first step toward building a sound approach to common stock investment. Chapter 18: The New Era Theory. The late 1920s created a powerful illusion. People began to believe that a new age of prosperity had arrived. Technology was advancing, industries were expanding, banks were lending freely. The stock market was rising almost every day. And in this climate, a dangerous idea was born. It was called the New Era Theory. The New Era Theory argued that the old rules of valuation no longer mattered. It claimed that stocks should not be measured by earnings, dividends, or assets. Instead, it said that the market itself had changed forever. That corporations had reached a stage of permanent growth. That prosperity would only increase. And that stock prices could rise indefinitely without limit. This theory appealed strongly to the human mind. It replaced caution with hope. It promised wealth without risk. And it seemed to be confirmed by everyday experience. As prices kept climbing, people felt the theory must be true. But Graham and Dodd exposed the danger here. The New Era theory was not an investment approach. It was speculation disguised as science. It rejected analysis. It rejected discipline. It turned the stock market into a casino where excitement replaced judgment. History gave a harsh verdict. When the crash of 1929 struck, the illusion collapsed overnight. Stocks that had been praised as safe forever lost 70 to 90% of their value. Investors who trusted in the new era were ruined. What was left was a hard lesson. No theory can cancel the basic principles of value. No amount of optimism can erase the difference between a sound business and an overpriced one. The chapter ends with a warning that remains true for every generation. Whenever people start saying, "This time is different," danger is near. The market may change its appearance, but human nature does not. And human nature always swings between greed and fear. If investors forget this, they will repeat the same mistakes. This naturally leads to the next question. If the New Era theory failed, then how should stocks be valued? What is the correct way to connect market price with company performance? The answer lies in the careful study of earnings. And this is where we turn in the next chapter to the problem of price-earnings ratios. Chapter 19. The dividend factor in common stock valuation. When people buy common stocks, what do they really expect? Some expect the price to go up. Some hope for long-term wealth. But at the heart of it all is a simple fact. Dividends are the investor's direct reward. They are the portion of profits that a company actually gives back to its shareholders. Benjamin Graham and David Dodd remind us that dividends were once seen as the foundation of value. A stock paying steady dividends was considered trustworthy. It showed that the company was not only earning money, but was also willing to share it. This direct flow of cash gave investors a sense of security. However, with the rise of the New Era thinking, attitudes toward dividends began to change. Companies started retaining earnings instead of distributing them. The argument was that reinvestment would create faster growth. If earnings were plowed back into the business, future profits would multiply. In theory, shareholders would benefit through higher prices later. This shift created tension. Should investors demand dividends now, or trust management to reinvest for tomorrow? The answer, as Graham and Dodd point out, is not one size fits all. Some companies are strong enough to reinvest wisely. Others may waste money on poor projects. And for the investor, patience is easier when the business has a proven record of growth. But ignoring dividends entirely is dangerous. A company that never pays out and promises only future gains can tempt investors into endless speculation. Without dividends, the link between a stock and actual business performance becomes weaker. The stock then becomes only a hope certificate, a bet on what might happen, not on what is real. Graham and Dodd do not reject reinvestment. They simply warn against blind faith. Dividends, they argue, still serve an essential purpose. They keep management accountable. They remind investors that ownership is not just about paper gains, but about a real share in profits. A sensible dividend policy balances the needs of growth with the rights of shareholders. So the dividend factor teaches us discipline. It forces us to ask, is the company rewarding us today or only promising tomorrow? And it shows us that valuation cannot be built on hopes alone. There must be a measurable return. This question naturally connects to the next idea. If dividends are one factor, what about the company's ability to keep earning steadily year after year? Because in the end, dividends depend on earnings. And that brings us to the next chapter, where we study the power and stability of earnings. Chapter 20. Earnings Power and Stability. If dividends are the visible cash reward, earnings are the hidden engine that makes those rewards possible. A company cannot pay dividends without earnings. So, for the intelligent investor, studying earnings is even more important than looking at price charts or market gossip. Benjamin Graham and David Dodd introduced the idea of earnings power. This means not just how much a company earned last year, but how consistently it can earn in the future. 1 year of high profits may be exciting, but it tells us very little about true strength. What matters is whether those profits can be repeated, and whether the business has the stability to survive tough times. Think of it like a person's job. If someone makes a big bonus 1 year, but has no stable career, the wealth is shaky. But if someone earns a steady salary every year, that income is reliable. Companies work the same way. The stability of earnings depends on many things: the industry it operates in, the demand for its products, the skill of its management, and also how much competition it faces. A company that makes profits in both good years and bad years is usually safer than one that shines only during booms. Graham and Dodd also warn about average earnings. Looking only at the most recent year can mislead investors. Instead, one should study results across 5 or 10 years. This longer view filters out temporary highs and lows and shows the real earning power of the business. But here is the trap. Investors sometimes confuse rapid growth with stability. A company may double its earnings for a few years, but growth is never permanent. What matters more is the company's ability to maintain a healthy level of earnings even when the economy slows. True stability lies not in how high earnings climb, but in how well they endure storms. Why is this important for valuation? Because the market often overpays for companies with exciting growth stories, while underestimating the quiet strength of stable earners. The wise investor looks beyond the headlines and asks, how solid are these earnings, and how long can they last? Earnings power and stability are also deeply connected to dividends. If earnings are stable, dividends are secure. If earnings are weak, dividends become risky. That is why earnings analysis sits at the heart of common stock valuation. This leads us naturally to the next key factor. Even if earnings are strong, what about the company's actual resources, the physical and financial assets it owns? Because in the long run, earnings rest on the foundation of assets. And that brings us to the next chapter, where we explore the asset value factor. Chapter 21. The asset value factor. So far, we have looked at dividends and earnings. But both of these depend on something deeper: the actual assets a company owns. Assets are the foundation of a business. They include things like factories, machinery, land, buildings, patents, cash, and inventory. Without assets, a company has nothing to work with. Benjamin Graham and David Dodd stress that investors should never ignore asset value. Why? Because assets act like the ultimate safety net. If a company stops earning profits for a while, its assets may still protect shareholders. In the worst case, if the company is liquidated, the value of assets can be used to pay off debts and sometimes return money to shareholders. Now, here is where the analysis gets interesting. Not all assets are equal. Cash is reliable, but inventory can lose value if products go unsold. Machinery may become outdated. Intangibles like goodwill or brand value are harder to measure. So, the intelligent investor does not simply accept the numbers written on the balance sheet. They adjust for reality, asking, what are these assets truly worth in the market today? One of Graham and Dodd's most famous ideas comes from this factor: the concept of net current asset value. This is when you take a company's current assets, like cash, receivables, and inventory, and subtract all current liabilities. If that number is higher than the market price of the stock, then the investor is essentially buying the company for less than its liquidation value. This is like buying a dollar for 50 cents. But remember, asset value alone does not make a company great. A business may own factories and equipment, but if it cannot use them profitably, the assets sit idle. That is why Graham and Dodd say asset value must be studied along with earnings power. Together, they give a fuller picture of both strength and potential. This balance is key. Earnings show us the flow of money today. Assets show us the foundation that supports tomorrow. When both are strong, the company stands on solid ground. For the investor, asset value also acts as a psychological anchor. When markets panic and stock prices fall, knowing the company has strong asset backing gives confidence to hold on, instead of selling in fear. So the asset value factor tells us something simple yet powerful. A stock is not just a piece of paper with a changing price. It represents a share of real resources, real property, and real value. And that naturally leads us to the next chapter. Because once we understand dividends, earnings, and assets, the final question is, how do these combine to form the true intrinsic value of a stock? And how does that compare with the ever-changing market price? This is where Graham and Dodd connect analysis to action. The relation of intrinsic value to market price. Chapter 22. The relation of intrinsic value to market price. We now arrive at one of the most important lessons in all of security analysis. Dividends show us the cash reward. Earnings show us the power to generate profit. Assets show us the foundation of value. But how do all these pieces come together? They combine into what Graham and Dodd call intrinsic value. Intrinsic value is the real worth of a stock. It is not the same as the market price you see on the exchange board. The market price is what people are willing to pay right now. It is driven by mood, fear, excitement, and speculation. Intrinsic value is what the business is actually worth, based on its earnings, assets, and future potential. Here lies the great paradox of investing. The market price often swings wildly above or below intrinsic value. In booms, enthusiasm pushes prices far higher than reality. In panics, fear drags prices far below true worth. The intelligent investor does not follow the crowd. Instead, they look for opportunities where the market price is much lower than intrinsic value. That difference is the margin of safety. But estimating intrinsic value is not a simple formula. It requires judgment. It requires weighing dividends, testing the stability of earnings, and carefully studying asset values. No two companies are the same, which means intrinsic value is always an estimate, not a perfect number. Still, even an estimate is better than blind speculation. Graham and Dodd remind us that markets are emotional, but businesses are rational. Over the long run, market price tends to move toward intrinsic value, but in the short run, prices can go anywhere. That is why patience is one of the greatest tools of the investor. The one who buys with discipline and waits for the market to recognize true value will be rewarded. So this chapter ties together everything we have learned in the theory of common stock investment. It tells us that the real art of investing lies in comparing intrinsic value with market price. When market price is much higher, avoid or sell. When it is much lower, buy with confidence. This simple but powerful idea separates the investor from the speculator. And now we are ready to move into the next major part of the book. If intrinsic value depends so much on earnings and assets, we must learn how to analyze them in detail. That begins with Part 5, where Graham and Dodd take us deep into the study of the income account. They show us how to separate real profits from illusions, and how to detect truth hidden behind company reports. Part V. Introduction. Analysis of the income account. Up to this point, we have studied theory. We explored the difference between investment and speculation. We looked at the role of dividends, earnings, and assets in finding intrinsic value. But theory alone is not enough. Now we move into practice. And the first practical step is to understand the income account. The income account, sometimes called the profit and loss statement, is the financial story of a company. It tells us how much money the business earned, how much it spent, and what remained as profit. To most investors, it looks simple. But Graham and Dodd warn us that appearances can be deceiving. Numbers on paper can be twisted, rearranged, or dressed up to look better than reality. A company may show large profits one year, but the truth may be very different once you dig deeper. Why is the income account so important? Because earnings power, the engine of valuation, comes directly from it. If the income account is misleading, then every calculation of intrinsic value becomes shaky. An investor who blindly trusts reported earnings is like a sailor navigating with a broken compass. The danger is obvious. This is why Graham and Dodd place such importance on analyzing the income account with care. Not just reading numbers, but questioning them. What do they really mean? What has been added? What has been hidden? And what might be temporary? In this part of the book, we will learn to recognize extraordinary profits and losses. We will study how depreciation and depletion are reported. We will examine methods like amortization, sinking funds, and reserves. Each of these can change the way a company's earnings appear on paper, and if misunderstood, they can mislead investors into false confidence. So Part 5 is where security analysis becomes detective work. We are no longer just accepting the story told by management. We are testing it, challenging it, and looking for the truth behind the report. And the journey begins with the most basic question. What is the true significance of the income account? That is where Chapter 23 takes us. Chapter 23. The significance of the income account. When an investor looks at a company, the first question is simple. Is this business making money or losing money? The answer lies in the income account. It is the central report that shows revenues, expenses, and profits. Without it, security analysis would be blind. Benjamin Graham and David Dodd remind us that the income account is more than just numbers. It is the record of how well management has used the company's resources. It shows whether the business can generate a steady flow of profits that will support dividends, strengthen assets, and create long-term value for shareholders. In short, the income account is the heartbeat of the company. But here is the warning. Not all earnings are created equal. Some profits are real, flowing from stable operations. Others are temporary, caused by unusual events or clever accounting tricks. If the investor does not separate the two, they risk making decisions based on illusions. Graham and Dodd point out that reported profits may look impressive, but they must be tested against reality. Did the company truly earn this amount through its normal business? Or was it boosted by a one-time gain, such as selling property or investments? Likewise, a reported loss may not always mean trouble. Sometimes it is just a temporary event that does not affect the core strength of the business. The intelligent investor therefore treats the income account as a starting point, not the final word. Numbers must be analyzed, adjusted, and interpreted. Only then can they reveal the company's true earning power. Another important point is the connection between income and valuation. Since intrinsic value rests heavily on earnings, any distortion in the income account will distort the investor's estimate of value. That is why the authors emphasize skepticism, patience, and a willingness to dig deeper. The job of the analyst is not to admire the glossy surface, but to search for the solid truth underneath. So the significance of the income account lies in this. It is both essential and unreliable. Essential because it is the main source of earnings information. Unreliable because it can be shaped, stretched, or decorated by accounting methods. The wise investor understands both sides. And this naturally leads us into the next topic. If the income account mixes true profits with temporary gains and unusual losses, then the first task of the analyst is to separate them. What counts as real, and what should be treated as exceptional? This question is the focus of the next chapter on extraordinary losses and profits. Chapter 24. Extraordinary losses and profits. Not all profits are normal. Not all losses are permanent. This is the key lesson Graham and Dodd teach in this chapter. When reading an income account, the analyst must separate the ordinary from the extraordinary. Ordinary profits and losses come from the regular business activities of a company. They repeat year after year, shaped by the company's operations, customers, and markets. Extraordinary items, on the other hand, are unusual. They do not reflect the steady rhythm of the business. For example, selling a piece of land at a large gain, suffering from a natural disaster, or writing off a bad investment. These events can make reported earnings look far higher or lower than reality. Why does this matter for investors? Because valuation depends on true earning power. If we count extraordinary profits as if they were ordinary, we may believe a company is far more successful than it really is. If we overreact to extraordinary losses, we may think the company is weaker than it truly is. Both mistakes can lead to poor investment decisions. Graham and Dodd suggest a simple discipline. Whenever you see unusual profits or losses, separate them in your analysis. Do not let them distort the picture of normal operations. A company's value is built on what it can earn steadily, not on one-time surprises. The authors also warn that management sometimes uses extraordinary items to their advantage. They may hide weak operating performance behind a sudden gain from asset sales. Or they may record heavy losses in 1 year, calling them extraordinary, so that future results look better by comparison. The analyst must be alert to these tactics. In the end, extraordinary items are like noise in the income account. They are real events, but they should not be confused with the company's true song. The intelligent investor listens carefully, filtering out the noise to hear the steady tune of normal earnings. This lesson naturally prepares us for the next challenge. If companies can use extraordinary items to shape perception, what about other accounting tricks? What about deliberate artifices designed to mislead? That is the subject of the next chapter, where Graham and Dodd expose the misleading devices that can hide the truth inside the income account. Chapter 25. Misleading artifices in the income account. Numbers can tell the truth, but numbers can also be twisted. This is the hard reality of financial statements. Graham and Dodd warn that companies sometimes use accounting artifices, clever tricks, to make earnings look better or worse than they truly are. The income account, instead of being a clear window into performance, can become a painted glass that hides the real picture. One common artifice is shifting expenses between periods. A company may delay recording certain costs so that current profits appear higher. Or it may pile up charges in 1 year so that future years look stronger. This timing game changes nothing about the business itself, but it changes how results appear on paper. Another artifice is inflating revenues. Management may record sales before they are actually earned, or treat uncertain payments as guaranteed income. This creates the illusion of growth, but the reality may collapse later. Then there are write-offs and reserves. Sometimes companies record large write-offs to sweep away past mistakes, calling them non-recurring. This makes the future look cleaner. But if such write-offs appear too often, it signals a deeper weakness in operations. Even small details can be misused. Depreciation may be recorded too lightly, keeping profits artificially high. Research and development costs may be hidden or spread in ways that mask true expenses. In each case, the picture shown to investors is brighter than the reality. Why do these artifices matter? Because investors make decisions based on reported earnings. If those earnings are manipulated, the foundation of intrinsic value becomes unstable. An investor who trusts distorted numbers risks paying too much or holding a company that is weaker than it seems. Graham and Dodd are clear. The analyst's duty is not to accept reports blindly, but to question them. Look for patterns. Ask why earnings suddenly improved. Check whether gains came from true business operations or from accounting creativity. Do not be impressed by glossy reports without testing their substance. This chapter is a reminder that financial analysis is not a passive act. It is detective work. And like all good detectives, analysts must be suspicious when things look too perfect. This naturally brings us to the next subject. One of the most common areas where artifices appear is depreciation and depletion. How companies record the wearing out of machinery, equipment, or natural resources can greatly affect reported profits. So in the next chapter, we explore these methods in detail. Chapter 26. Methods of depreciation and depletion. Every business owns assets that wear out over time. Machines break down. Buildings age. Mines and oil fields lose their resources. This natural decline is called depreciation when it applies to man-made assets, and depletion when it applies to natural resources. For investors, depreciation and depletion are crucial because they affect reported profits. If a company ignores them or records them incorrectly, the income account becomes misleading. The business may look more profitable than it truly is. Benjamin Graham and David Dodd explain that depreciation is not just a bookkeeping entry. It is a real economic cost. Every machine has a limited life. If its cost is not gradually charged against earnings, the company is living on borrowed time. Eventually, equipment must be replaced, and if no funds have been set aside, shareholders may face losses. Different companies use different methods of depreciation. Some spread the cost evenly over the life of the asset, called the straight-line method. Others load more expense in the early years, assuming the asset wears out faster at the beginning. Each method changes the pattern of reported earnings. even though the long-term economic reality is the same. Depletion works in a similar way, but it applies to natural resources. When oil is pumped or minerals are mined, part of the resource is gone forever. If the company fails to record this loss of value, profits are overstated. Investors may believe the business is healthier than it really is, until the resource runs dry. The analyst's job is to check whether depreciation and depletion are reasonable. Too little expense makes profits look inflated. Too much expense may hide real earning power. Both distort the picture of intrinsic value. Graham and Dodd stress that depreciation and depletion are not optional. They are unavoidable facts of business life. Companies that treat them honestly show respect for their shareholders. Companies that manipulate them are playing a dangerous game. So, this chapter reminds us that the income account must be read with a sharp eye, not only for extraordinary profits or artifices, but also for basic accounting of assets and resources. Because only when these charges are fair and realistic can reported earnings be trusted. This naturally leads us to the next subject. If depreciation and depletion reduce profits to reflect the wearing out of assets, then how do companies prepare for repaying debts or long-term obligations? That is where amortization and sinking funds come into play. And that is the focus of the next chapter. Chapter 27. Amortization and sinking funds. After understanding depreciation and depletion, we now come to two related financial practices: amortization and sinking funds. At first, these may sound like technical accounting terms, but their logic is simple. Both deal with preparing for the future, repaying obligations, and spreading costs across time. Amortization is the gradual repayment of debt or the systematic writing off of intangible assets. Think of it as paying down a loan in small, regular installments instead of waiting for one giant payment at the end. This method reduces risk for both lender and borrower. The company avoids a crushing final payment, and investors can see steady progress. Amortization also applies to intangibles like patents, goodwill, or leaseholds. These don't have physical form, but they still have a limited life. Their cost must be allocated across the years they provide value. If ignored, earnings appear overstated, and the business may seem stronger than it truly is. On the other hand, sinking funds are a more formal method of preparing for debt repayment. A company issues bonds, promising to pay them back after, say, 20 years. Instead of waiting until the end to raise a huge sum, it sets aside money regularly in a sinking fund. This fund grows over time, either by investment or accumulation, until it can retire the debt. For investors, sinking funds offer a sense of security. They reduce the danger of default. But Graham and Dodd warn us, not all sinking funds are equally safe. If the money is not properly invested, or if the company uses it for its own benefit rather than keeping it separate, the protection is only on paper. The analyst must ask, is the sinking fund real cash or just an accounting promise? Together, amortization and sinking funds highlight the theme of this section: prudence. A good business does not only focus on current profits, but also plans for inevitable future obligations. Just as depreciation anticipates worn-out assets, amortization and sinking funds anticipate maturing debts. This leads naturally to the next question. What is the impact of all these charges, depreciation, depletion, amortization, and sinking funds, on the company's cash position? How do they shape the flow of real money, not just accounting entries? That is the central issue of the next chapter. Chapter 28. Maintenance of surplus reserves. When companies earn profits, they face a crucial choice. Should all those profits be distributed to shareholders as dividends, or should part of it be held back? This held back portion is called a reserve. At first glance, keeping profits in reserve instead of paying them out may seem like depriving shareholders of their reward, but reserves have an important protective purpose. They are a financial cushion against future risks. Business is uncertain. Losses, accidents, or sudden downturns can strike at any time. Surplus reserves allow the company to absorb such shocks without collapsing. For investors, the existence of reserves is a double-edged sword. On the positive side, they show foresight. Management is not reckless. It is preparing for the unexpected. But reserves can also be misused. Sometimes managers hold back more profits than necessary, not for safety, but to manipulate how earnings appear on paper. If reserves are too large, reported profits shrink artificially, making the company look less successful than it really is. This can discourage investors or lower stock prices, which in some cases might even benefit insiders who want to buy shares cheaply. Therefore, analysts must examine reserves carefully. The key questions are: is the reserve truly justified? Does it protect against genuine risks like equipment breakdown, lawsuits, or unstable markets? Or is it simply a convenient way to conceal real earnings? Benjamin Graham emphasizes balance. A wise company maintains reserves that are reasonable in size. Not too small, which would leave the firm exposed. Not too large, which would misrepresent profits and reduce shareholder value. The reserve should match the actual needs of the business, not the whims of management. In essence, surplus reserves are like an emergency fund for a household. They provide security, but if overstuffed, they may raise suspicion about what is being hidden. For the intelligent investor, reserves must always be analyzed alongside dividends, earnings, and actual financial risks. And this leads to the next issue. How do reserves, depreciation, and other protective charges connect with maintenance of assets? Because at the end of the day, reserves are not just numbers. They are meant to ensure the company's physical and operational health. That is exactly the focus of the next chapter. Chapter 29. The relation of depreciation to maintenance. Depreciation is not just an accounting number. It is a measure of how much a company's assets are wearing out over time. But knowing the depreciation alone is not enough. The real question is the company maintaining its assets properly? Because if depreciation is recorded, but assets are neglected, reported earnings may be misleading. Benjamin Graham and David Dodd stress that maintenance is the practical side of depreciation. Machines, buildings, and equipment require repairs, replacement, and constant attention. If maintenance is postponed, assets deteriorate faster than recorded depreciation, reducing future earnings and threatening long-term value. Investors often focus on profits, ignoring whether the company reinvests in its business. But a high profit today with poorly maintained assets may create a cash flow illusion. Tomorrow, the business may need huge expenditures just to restore operations. This could erode earnings, lower dividends, and even threaten the survival of the company. Graham and Dodd also point out that depreciation methods can disguise reality. A company may use straight-line depreciation to keep profits steady, while in reality, equipment is wearing out faster. Or it may overstate depreciation to reduce taxable income, making profits appear lower than actual cash flow. The investor must compare depreciation recorded with actual spending on repairs and replacements. This chapter teaches a simple but powerful lesson. Earnings are meaningful only when assets are maintained properly. True value lies in the business's ability to keep producing goods and services at consistent quality and cost. If assets are neglected, profits today are borrowed from tomorrow. Understanding this relation between depreciation and maintenance naturally prepares us for the next major step. Once we know how income and asset health connect, we can move on to studying the balance sheet. The balance sheet shows the full financial structure of a company, detailing cash, receivables, inventory, liabilities, debt, and equity. It is where all these concepts, profits, reserves, depreciation, and maintenance, come together in one place. Part 6, Balance Sheet Analysis, begins the next chapter, giving the investor tools to see the company's real financial strength. Part 6, Introduction, Balance Sheet Analysis. Up to now, we have focused on the income account, dividends, earnings, extraordinary items, reserves, depreciation, and maintenance. We have studied how to measure a company's earning power and its ability to pay dividends. But earnings alone do not tell the full story. To understand a company's true financial health, we must look at the balance sheet. The balance sheet is like a snapshot of the company at a particular moment. It shows what the company owns, what it owes, and what is left for shareholders. In other words, it reveals assets, liabilities, and equity. Together, these elements tell us whether the company is financially stable, under stress, or over-leveraged. Benjamin Graham and David Dodd stress that balance sheet analysis is more than just reading numbers. It is about interpreting them. Cash may be plentiful today, but is it enough to cover short-term liabilities? Assets may look valuable on paper, but are they real or overestimated? Debt may seem small, but are the repayment terms manageable? The balance sheet also shows the results of past decisions. Profits retained as reserves, depreciation recorded over time, and amortization of debt all appear here. By studying these carefully, the analyst can see how prudently management has run the company. A strong balance sheet gives confidence that the business can survive unexpected shocks and continue generating profits. In this part of the book, we will examine each component of the balance sheet in detail. We will look at cash and cash equivalents, receivables, inventory, fixed assets, intangibles, current liabilities, funded debt, and capital stock. We will learn how to evaluate their quality, reliability, and potential risks. Balance sheet analysis is the bridge between theory and practice. It takes the lessons of earnings, reserves, depreciation, and maintenance, and shows how they impact the company's overall financial structure. Once we understand this, we can make informed judgments about intrinsic value and investment decisions. The journey begins with Chapter 30, where Graham and Dodd explain the general principles of balance sheet analysis. Here, the investor learns to read the financial snapshot and interpret what it truly says about the company. Chapter 30. Balance sheet analysis in general. The balance sheet is one of the most important tools for an intelligent investor. It is a snapshot of a company's financial condition at a particular moment. It lists everything the company owns, everything it owes, and what remains for shareholders. But Graham and Dodd warn that simply reading these numbers is not enough. True analysis requires interpretation. Every item on the balance sheet tells a story. Cash shows immediate liquidity. Receivables indicate sales that have not yet been collected. Inventory represents products ready for sale. Fixed assets show long-term investments like buildings, machinery, and equipment. Intangibles reflect goodwill, patents, or trademarks. Liabilities reveal debts, obligations, and potential risks. Capital stock represents ownership interests. The key to analysis is understanding both quantity and quality. A large cash balance may look comforting, but is it genuine and readily available? Receivables may seem valuable, but are customers likely to pay? Inventory may be overstated, obsolete, or hard to sell. Fixed assets may be old, worn out, or inefficient. Intangibles may be overestimated by management. Graham and Dodd also emphasize that balance sheet analysis is not just about the present. It is about trends, policies, and consistency over time. How have reserves been maintained? Has debt been growing responsibly or recklessly? Are earnings being reinvested wisely or consumed carelessly? Investors must be careful not to take reported values at face value. Adjustments are often necessary to reflect real worth, economic conditions, and risk. For example, depreciation, depletion, and amortization affect the true value of assets. Liabilities may carry hidden obligations. Capital stock may have rights or restrictions that influence its value. In short, balance sheet analysis is a combination of detective work and judgment. It is about reading between the lines and seeing the financial reality behind the numbers. Only then can the investor form a complete picture of a company's strength, stability, and long-term potential. This chapter sets the stage for examining each component in detail. We start with the most liquid and immediate item on the balance sheet: cash assets. Cash is the lifeblood of a company. Understanding its size, availability, and use is essential before analyzing other parts of the balance sheet. Chapter 31. Cash assets. Cash is the lifeblood of any business. No matter how profitable a company may appear on paper, without cash, it cannot operate. It cannot pay employees, suppliers, or creditors. It cannot invest in growth or cover unexpected losses. This is why Graham and Dodd emphasize careful analysis of cash assets. Cash assets include money in the bank, cash on hand, and short-term investments that can be quickly converted to cash. At first glance, a high cash balance seems reassuring, But the intelligent investor asks deeper questions. Is the cash genuinely available, or is it tied up in restricted accounts or collateral? Is it sufficient to cover current liabilities? Does it reflect proper management policies, or is it just a temporary surplus? Another key consideration is how cash is used. Some companies hoard cash unnecessarily, which can reduce returns for shareholders. Others spend cash recklessly, risking liquidity problems. The balance between safety and efficiency is essential. Investors must determine whether management is using cash prudently to support business operations and growth. Cash analysis also requires looking at trends over time. A declining cash position might signal problems even if reported earnings are strong. Conversely, a sudden increase in cash may be temporary, or the result of asset sales rather than healthy operations. Graham and Dodd stress that cash alone does not tell the whole story. It must be examined alongside other current assets, liabilities, and operational needs. Cash provides flexibility and protection, but its real significance depends on context. Understanding cash assets prepares the investor for the next layer of the balance sheet: receivables and inventory. These are the assets that represent sales already made or products waiting to be sold. While they are not as liquid as cash, they are critical to the company's ongoing operations and potential profitability. Proper analysis of these items ensures that earnings are real, collectible, and not overstated. In the next chapter, we will learn how to evaluate receivables and inventory, separating genuine value from potential risk, and seeing how they affect both liquidity and overall financial health. Chapter 32: Receivables and Inventory. After cash, the next crucial items on the balance sheet are receivables and inventory. Receivables are amounts owed to the company by customers who have purchased goods or services on credit. Inventory represents the products, raw materials, and supplies that the company keeps for sale or production. At first glance, large receivables and inventory may seem positive. They suggest strong sales and business activity. But Graham and Dodd warn that not all receivables are collectible, and not all inventory is valuable. Receivables must be examined carefully. Some customers may delay payment or even default entirely. If the company overstates receivables, it gives the illusion of higher earnings and financial strength than actually exists. Analysts look for trends over time. Are receivables growing faster than sales, suggesting problems in collection? Are adequate allowances for doubtful accounts recorded? Inventory, too, can be misleading. Some inventory may be obsolete, slow-moving, or overvalued. If a company has built up stock that cannot be sold at cost or market price, it is essentially tied up cash that earns nothing. Overstated inventory inflates profits by reducing cost of goods sold, while hiding potential losses. Graham and Dodd emphasize quality over quantity. It is not enough to have large receivables or a big inventory. The question is whether these assets are real, collectible, and usable. The analyst must adjust reported figures to reflect their actual economic value. Receivables and inventory analysis also ties directly into liquidity. A company may have large profits on paper, but if receivables cannot be collected or inventory cannot be sold, cash flow suffers. This can limit operations, reduce dividends, and even threaten solvency. Once we understand the significance and risks of receivables and inventory, we naturally move to fixed assets. These are long-term investments like land, buildings, and machinery. Unlike cash, receivables, or inventory, fixed assets are less liquid, but they form the backbone of a company's operations. Analyzing them carefully is essential to understanding the company's true value and long-term stability. In the next chapter, we will explore Chapter 33, Fixed Assets, learning how to assess their worth, condition, and impact on intrinsic value. Chapter 33, Fixed Assets. Fixed assets are the long-term backbone of a company. They include land, buildings, machinery, equipment, and other resources used in day-to-day operations. Unlike cash or inventory, fixed assets are not easily converted to money. Yet their value is critical because they generate the company's future earnings. Graham and Dodd emphasize that fixed assets must be analyzed carefully. The balance sheet may report them at historical cost, which might be far different from their real market value or productive capacity. A building purchased decades ago may be recorded at a low cost, but its replacement cost today could be much higher. Similarly, machinery may appear valuable on paper, but be worn out, obsolete, or inefficient. Depreciation plays a key role in fixed asset analysis. It accounts for the wear and tear of these assets over time. But investors must go further than the numbers. They should evaluate whether the company is maintaining its assets properly. Neglected machines or outdated equipment can reduce future profits even if the balance sheet shows large asset values. Another consideration is fixed asset liquidity. Even if an asset has high theoretical value, it may be difficult to sell quickly without a loss. Investors need to understand which assets are truly available to support operations or provide security in case of financial trouble. Graham and Dodd also warn that some fixed assets are more critical than others. Land often retains value, but specialized machinery may not. Buildings may need continuous investment to remain functional. The analyst's task is to separate stable, reliable assets from those that carry risk or hidden cost. Understanding fixed assets sets the stage for the next part of the balance sheet. Intangibles. Intangible assets like goodwill, patents, trademarks, and brand value are increasingly significant in modern business. They have no physical form, but can contribute heavily to earnings and company value. Yet they are also more subjective and harder to evaluate than fixed assets. In the next chapter, we will examine Chapter 34, Intangibles, learning how to assess these non-physical assets and their impact on intrinsic value and investment decisions. Chapter 34, Intangibles. Intangible assets are the invisible yet powerful elements of a company. They include goodwill, patents, trademarks, copyrights, brand reputation, and other non-physical resources. Unlike land, buildings, or machinery, you cannot touch or see them, but they can significantly influence a company's earnings and market value. Graham and Dodd warn that intangibles are double-edged. On one side, they can provide a real competitive advantage. A strong brand, for example, allows a company to charge premium prices. Patents protect innovation and future profits. Goodwill may reflect the loyalty of customers, relationships with suppliers, and efficiency of operations. On the other side, intangibles are highly subjective. Their value can be inflated by management, optimistic assumptions, or creative accounting. Unlike fixed assets, they are harder to measure and more difficult to replace. If goodwill or brand reputation is impaired, a company may face sudden losses that are not immediately visible in historical costs. Analysts must ask critical questions. Is the reported value of intangible assets realistic? Can it support future earnings? How easily can it be converted into cash if necessary? Are there risks of impairment or loss that could affect shareholders? Graham and Dodd emphasize caution. Do not assume that large intangible assets automatically mean a strong company. Evaluate their quality, longevity, and true contribution to the business. Look for tangible evidence that the intangible is generating revenue, protecting profits, or reducing costs. Understanding intangibles prepares the investor for the next major component of the balance sheet: current liabilities. Current liabilities are obligations the company must meet in the short term, such as accounts payable, taxes, and short-term loans. These are critical because even a company with valuable tangible and intangible assets can face liquidity problems if it cannot meet its immediate obligations. In the next chapter, Chapter 35, Current Liabilities, we will learn how to analyze these short-term obligations and their impact on financial stability and investment decisions. Chapter 35, Current Liabilities. Current liabilities are the company's short-term obligations. These are debts and responsibilities that must be paid within a year, such as accounts payable, wages, taxes, and short-term loans. Graham and Dodd emphasize that no matter how strong a company's assets or earnings appear, failure to manage current liabilities can create serious problems. For investors, the key question is liquidity. Can the company meet its short-term obligations with available cash and other current assets? Even profitable companies can fail if they cannot pay what they owe when it is due. This is why current liabilities must be analyzed in connection with cash, receivables, and inventory. The balance between current assets and current liabilities is often expressed as the current ratio. A ratio above 1 suggests the company has more current assets than current liabilities, providing a safety margin. However, Graham and Dodd warned that the ratio alone is not enough. The quality of assets matters. Receivables may be uncollectible. Inventory may be slow-moving or obsolete. Only effective liquid assets count when meeting obligations. Another consideration is timing. Some liabilities are predictable, like wages and rent. Others, such as tax obligations or short-term loans, may require careful planning. Unexpected demands on cash can stress a company if not anticipated. Management's policy toward current liabilities is also important. Some companies stretch payments to suppliers to conserve cash, but excessive delay can harm relationships or incur penalties. Others pay promptly, maintaining trust and operational stability. Understanding current liabilities naturally leads to long-term obligations, which are analyzed under funded debt. Funded debt consists of loans and bonds due over several years. Its size, interest rates, and repayment schedule affect a company's stability and long-term earning power. In the next chapter, Chapter 36, Funded Debt, we will explore long-term debt in detail, learning how to evaluate its risk, terms, and impact on the company's financial strength. Chapter 36, Funded Debt. Funded debt refers to long-term obligations that a company must repay over a period longer than 1 year. This includes bonds, long-term loans, and other financial commitments. Graham and Dodd stress that funded debt is a critical element of the balance sheet because it affects both risk and stability. Investors must ask several questions when analyzing funded debt. What is the total amount of long-term debt? What are the interest rates and repayment schedules? Is the company generating enough earnings and cash flow to meet interest and principal payments comfortably? Unlike current liabilities, funded debt does not require immediate repayment. However, it can still create significant pressure on a company if earnings decline or unexpected expenses arise. High levels of debt increase financial risk even if the company appears profitable. Conversely, a moderate level of funded debt, when well managed, can enhance returns by providing capital for growth. Graham and Dodd also emphasize the quality of the debt. Secured bonds backed by specific assets offer more safety to investors than unsecured debt. Covenants attached to loans may restrict management actions, affecting flexibility. Analysts must examine both the legal and economic aspects of funded debt to understand the real risk. Another important factor is maturity structure. Debt that matures all at once can create a refinancing problem, whereas staggered repayment spreads the burden over years. Companies that plan their debt carefully show prudence and foresight, which increases investor confidence. Funded debt connects directly to capital stock. The proportion of debt to equity affects the company's financial leverage. Too much debt relative to capital stock can magnify losses in tough times, while too little may indicate the company is underutilizing opportunities for growth. Understanding funded debt allows the investor to see the balance between risk and return. It also sets the stage for evaluating the company's ownership structure, capital stock, and overall financial strength. In the next chapter, Chapter 37, Capital Stock, we will explore equity in detail, examining shares, voting rights, dividends, and how they relate to the company's long-term value and stability. Chapter 37, Capital Stock. Capital stock represents ownership in a company. It is the equity that shareholders hold after all liabilities are subtracted from assets. Understanding capital stock is crucial because it determines both control of the company and claim on profits. Graham and Dodd explain that not all capital stock is equal. There may be common stock, preferred stock, and even different classes of shares with varying rights. Common shareholders typically have voting rights and participate in profits through dividends, but they are last in line if the company is liquidated. Preferred shareholders may receive fixed dividends and have priority in claims, but often have limited or no voting power. Investors must look beyond the number of shares issued. Important considerations include the par value, which is the nominal value of a share, and the market value, which fluctuates based on supply, demand, and perceived company performance. Graham and Dodd also emphasize understanding dividend policy. A company may retain earnings to fund growth, pay consistent dividends, or use a mix of both. The approach affects both long-term value and investor returns. Another key aspect is capital structure. The proportion of equity to debt affects financial stability and risk. A company heavily financed by debt is more vulnerable to economic downturns, while a company funded mostly by equity may have slower growth but greater safety. Capital stock also reflects past management decisions. Issuance of new shares, stock splits, and buybacks can influence the ownership structure, control, and intrinsic value of each share. For the analyst, it is essential to evaluate both the quantity and quality of capital stock. Understanding capital stock prepares the investor to compare companies effectively. After analyzing assets, liabilities, and equity, we can begin comparative analysis, seeing how one company stacks up against another in profitability, financial strength, and risk. In the next part, Part 7, Additional Aspects of Security Analysis, we begin with Chapter 38, Comparative Analysis of Companies, exploring techniques to evaluate multiple companies and make informed investment decisions. Part 7, Additional Aspects of Security Analysis. By now, we have studied bonds, preferred stocks, and common stocks in depth. We have learned how to evaluate earnings, dividends, and assets. We have explored balance sheets and income accounts. We understand intrinsic value and the importance of a margin of safety. But investing is not just about numbers on a page. It is also about context, how a company compares with its competitors, how the market perceives industries, how groups of securities behave together, and how discrepancies between price and value can create opportunities. Part 7 brings all these additional aspects into focus. It takes analysis beyond individual companies and looks at patterns across businesses, industries, and the market as a whole. It helps investors understand not only whether a stock is sound, but whether it is attractive relative to others. It shows the importance of comparison, grouping, and classification in building a strong portfolio. The goal of this section is to expand our toolkit. Numbers alone are not enough. We need perspective, judgment, and a broader understanding of the market environment. Only then can analysis guide confident investment decisions rather than guesswork. This naturally leads us to the first chapter of Part 7, where we begin with the comparative analysis of companies. By studying competitors side by side, we can identify strengths, weaknesses, and real opportunities in the market. Chapter 38, Comparative Analysis of Companies. Up to this point, we have learned how to study a single company in detail. We have examined its earnings, assets, dividends, and intrinsic value. But investing does not happen in isolation. A company exists in a world full of competitors, peers, and industry trends. Benjamin Graham and David Dodd introduce comparative analysis as a powerful tool. It means studying companies side by side, not just their financial statements, but also their management, growth potential, and market position. By comparing multiple companies, the investor can spot which businesses are truly strong and which are weak. This method prevents one of the most common mistakes in investing. Sometimes a company looks good alone, but compared to its peers, it is average or below average. For example, a firm may show stable profits, but if competitors are growing faster and capturing market share, the company is not as attractive. Comparative analysis also highlights trends in the industry. If multiple companies show improving margins or expanding markets, that signals strength in the sector. Conversely, if all competitors are struggling, a single company's success may be fragile or temporary. The approach is both quantitative and qualitative. Numbers tell part of the story, but management quality, strategic positioning, and innovation are equally important. The best investors combine these factors to make decisions grounded in facts and judgment. Graham and Dodd emphasize patience. Comparative analysis is not about rushing to buy the hottest stock. It is about seeing the bigger picture, finding value where the market has overlooked it, and avoiding companies that appear strong but are weak compared to their peers. This chapter sets the stage for the next step. Once we understand individual and comparative company analysis, We can expand to group studies of securities. By looking at multiple companies together, trends emerge. Patterns in industries, sectors, and markets help investors make better choices. And that is exactly what we explore in the next chapter. Chapter 39. Group Studies of Securities. So far, we have examined individual companies and compared them to their peers. Now Graham and Dodd expand the lens even further. They introduce the concept of group studies of securities. Instead of looking at one company at a time, the investor studies a collection of companies within an industry, sector, or market. The purpose of group analysis is simple but powerful. Patterns begin to emerge. Trends that are invisible in a single company become clear when multiple companies are studied together. For example, if an entire industry is showing declining earnings, even strong companies may face challenges. Conversely, rising profits across a group can signal broader growth opportunities. This method also reduces risk. By understanding the overall health of a group, the investor can avoid putting money into sectors that are likely to struggle. It provides a form of early warning. Instead of reacting to sudden changes in a single company, the investor can anticipate shifts in the market. Graham and Dodd emphasize that group studies are both quantitative and qualitative. Numbers like revenue growth, profit margins, and debt levels are essential. But so are qualitative factors. Industry regulations, technological changes, consumer preferences, and management quality all play a role. One of the key insights is that market sentiment often moves groups of securities together. A single company may have strong fundamentals, but if the market is pessimistic about its sector, its price may still fall. Understanding group behavior helps investors recognize when the market is mispricing opportunities or risks. Group studies also help in selecting undervalued stocks. By comparing companies across a sector, the intelligent investor can spot which ones are trading below intrinsic value relative to their peers. This creates opportunities to buy solid businesses at attractive prices. This naturally leads to the next topic. Once we understand how groups of securities behave, we need to study the market as a whole. How prices are formed, how sentiment drives valuation, and how security analysis interacts with market trends. This is exactly what Chapter 40 explores: market analysis and security analysis. Chapter 40: Market Analysis and Security Analysis. So far, we have studied individual companies, compared them to peers, and looked at groups of securities. Now Graham and Dodd expand our view to the entire market. They emphasize that a stock does not exist in isolation. Market forces, investor behavior, and overall economic trends influence prices. Market analysis is the study of how the collective actions of investors affect security prices. It seeks to understand trends, cycles, and sentiment. It does not replace company analysis. Instead, it complements it. The intelligent investor considers both intrinsic value and market behavior. One of the key lessons is that markets are often driven by psychology. Fear and greed push prices far above or below what is justified by fundamentals. Speculation can create bubbles. Panic can trigger steep declines. Understanding these patterns can help the investor act with confidence rather than emotion. Graham and Dodd warn against blindly following the market. Market highs are not always a signal to buy. Market lows are not always a reason to sell. Instead, the investor must identify where the market has mispriced securities. This is where the principles of security analysis come into play. By combining knowledge of company fundamentals with awareness of market sentiment, investors can find opportunities that others overlook. Market analysis also helps in timing decisions. It does not promise perfect predictions, but it can guide whether to be cautious, aggressive, or patient. By recognizing trends and patterns, the investor reduces the risk of buying at the top or selling at the bottom. Ultimately, Graham and Dodd show that the market is both an ally and a challenge. It provides liquidity, opportunities, and price discovery. But it also introduces irrational swings and emotions. The goal of security analysis is to navigate this landscape intelligently, to separate fact from hype, to focus on value rather than short-term excitement. This naturally leads to the next chapter. Once we understand how the market behaves, the next step is to study discrepancies between price and value. How and why the market often misprices securities, and how the investor can use this knowledge to their advantage. Chapter 41 explores this concept in detail. Chapter 41: Discrepancies between price and value. One of the most important lessons in investing is this: the market price of a security and its intrinsic value are often very different. Graham and Dodd call these differences discrepancies. Recognizing them is the key to successful investing. Market prices are influenced by emotions, rumors, news, and speculation. Fear can push a stock far below its true worth. Greed can inflate prices far beyond reality. Sometimes a company is excellent, but investors ignore it. Sometimes a company is weak, but investors drive its price up. These gaps between price and value create opportunity. The intelligent investor does not follow the crowd blindly. Instead, they ask, what is this company really worth? How strong are its earnings? How solid are its assets? Does it have a reliable dividend history? And how does this intrinsic value compare with the market price? Discrepancies also reveal the danger of speculation. Many investors buy stocks because of price momentum. They follow trends or listen to popular advice. But momentum does not equal value. By ignoring fundamentals, these investors take unnecessary risk. Meanwhile, the disciplined investor can buy when prices are below intrinsic value and sell when prices rise above it. Graham and Dodd emphasize patience. Discrepancies do not correct immediately. The market can remain irrational longer than expected, but over time, value tends to be recognized. And the investor who has calculated intrinsic value and waited for the right opportunity is rewarded. This chapter also connects closely to market behavior. Understanding discrepancies is not just about one company. It requires looking at groups, sectors, and the market as a whole. By combining company analysis, group studies, and market observation, the investor can find the safest and most profitable opportunities. With this understanding, the next step is to classify securities. Different securities behave differently. Some are safe and predictable. Others are speculative or volatile. Knowing the type of security helps the investor apply the right analysis and make better decisions. This leads directly into Chapter 42, where Graham and Dodd explain the classification of securities by character. Chapter 42: Classification of securities by character. Not all securities are created equal. Some are safe, reliable, and steady. Others are risky, speculative, and unpredictable. Graham and Dodd stress that understanding the character of a security is essential for intelligent investing. Securities can be classified in several ways. First, by their claim on income and assets. Bonds and preferred stocks are senior securities. They have priority over common stock in receiving payments and liquidation proceeds. Common stocks, on the other hand, are residual claims. They receive what is left after all obligations are met. Second, securities can be classified by their risk and stability. Some offer steady interest or dividends with low risk of loss. Others fluctuate wildly in price and may not pay consistent income. Investors must understand these differences before committing money. Third, securities can be distinguished by their speculative features. Convertible bonds, warrants, and growth stocks may offer higher potential rewards, but they also carry higher uncertainty. Investors who treat them as safe investments may suffer heavy losses. Graham and Dodd emphasize that classification is more than a theoretical exercise. It directly influences investment strategy. Safe, fixed income securities are appropriate for conservative investors. Speculative securities may be suitable only for those willing to take calculated risks. Classification also helps in portfolio construction. A balanced portfolio mixes different types of securities according to the investor's goals, risk tolerance, and time horizon. It ensures that even if some investments underperform, others provide stability. Finally, understanding the character of securities reinforces one of the central themes of the book. Investment is not guessing or chasing trends. It is matching your knowledge, discipline, and judgment to the right type of security. When this is done correctly, The margin of safety is preserved, and the investor avoids unnecessary losses. With this framework in place, we are ready for the book's final message. All the lessons of security analysis, valuation, dividends, earnings, assets, market behavior, and classification point to one concept: the margin of safety. This is the central principle of intelligent investing, and it is the focus of Part 8, the global conclusions of the book. Part 8, Global Conclusions. We have now completed a long journey through the principles of security analysis. From bonds to preferred stocks, from common stocks to balance sheets, and from earnings to market behavior. We have studied individual companies, compared them to peers, and looked at groups of securities. We have seen how intrinsic value differs from market price, and how discrepancies create opportunities. Part 8 brings all these lessons together. It is the moment to reflect on the big picture. The authors show that all the details, rules, and calculations point to one central idea. This idea is simple but powerful. It is the foundation on which intelligent investing rests. The global conclusions do not introduce new methods. Instead, they emphasize principles that must guide every investor: patience, discipline, judgment, and most importantly, caution. Investing is not about chasing excitement or following trends. It is about understanding value, assessing risk, and protecting your capital. All the previous parts prepare us for this final lesson. Every chapter has contributed a piece of the puzzle: earnings, dividends, assets, market behavior, security classification. Each element reinforces the same theme. That theme is the margin of safety. The idea that every investment should have a buffer against error, misfortune, or unexpected changes. This part serves as the bridge between knowledge and action. It tells the investor not just what to study, but how to act wisely. It reminds us that the true goal of security analysis is not speculation or gambling. It is protection. It is disciplined growth. It is intelligent decision-making in the face of uncertainty. And this naturally leads into the final chapter, where Graham and Dodd explain the margin of safety as the central concept of investment. It is the principle that ties together everything in the book and guides every sound investment decision. Chapter 43. The margin of safety as the central concept of investment. After studying all the details of security analysis, Graham and Dodd bring us to the most important lesson: the margin of safety. It is the principle that separates intelligent investing from speculation. The idea is simple. No matter how carefully we analyze a company, there is always uncertainty. Earnings may fall. Assets may lose value. The market may behave irrationally. The margin of safety is a cushion that protects us from these unknowns. When we buy a security, we do not want to pay exactly its estimated intrinsic value. We want to pay less. The difference between the intrinsic value and the purchase price is the margin of safety. This gap provides room for errors in judgment, unexpected changes in business, or sudden market downturns. Graham and Dodd emphasize that the margin of safety is not a number. It is a mindset. It is the discipline to avoid overpaying. It is the patience to wait for favorable prices. It is the wisdom to balance risk and reward. The margin of safety applies to all types of securities. Bonds, preferred stocks, and common stocks can all be analyzed with this principle in mind. Even when investing in strong, stable companies, the investor must account for uncertainty. No investment is completely risk-free. This concept also connects all the previous lessons. Dividends, earnings, assets, and intrinsic value are the tools to measure safety. Market analysis and comparative studies are the guides to opportunity. Classification of securities shows how to match risk tolerance with investment type. And ultimately, the margin of safety is the final check before committing money. Graham and Dodd remind us that this principle has stood the test of time. It protected investors during crashes, recessions, and periods of speculation. It is the cornerstone of value investing. It teaches humility, it teaches caution, and it teaches respect for the uncertainty that is always present in the market. The intelligent investor who embraces the margin of safety acts with knowledge, discipline, and patience. They understand that true wealth is built not by chasing excitement, but by preserving capital and making informed decisions. All the chapters of this book point to this central lesson. Every analysis, calculation, and observation ultimately serves one purpose: to find value, to avoid loss, and to invest with a margin of safety. This is the principle that guides action in the real world. It is the foundation of long-term investing success, and it is the enduring legacy of Benjamin Graham and David Dodd's work in security analysis.